Well, hello and welcome to Trading Blows from TraderX. Another busy show this week. Plenty for us to discuss as signs of calm start to emerge in the markets. Investors seeming to breathe a little bit of a sigh of relief. Signs that the banking breakdown may be sort of starting to get into the rearview mirror just a little bit. We also dig into the central bank decisions that we had last week, including 25 basis point hikes from the BOE and the FOMC over in the States. And we also look east to see whether markets and investors can find some opportunity over in Asia. Without further ado, let's get into the show. A busy show this week, plenty to discuss, so let's meet our panellists. As always, they'll go head-to-head over 4 rounds, scoring points for a great response, with a thread of points being chalked off if a dispute is raised over their answer. The better the answer, the more points they will score. Joining us this week, Ryan Paisey, the founder of PiQSuite, market intelligence and news platform, from his office this time, not in the kitchen. We've also got Arno Venter, power permitting, from South Africa, market analyst with Financial Source, developer of proprietary trade generation and market analysis tools. And last week's winner, back once again, Ioan Smith, of 20 years of market experience in Tier 1 banks and running his own research firm as well. With that said and done, let's get into the first round. So I want to talk about the Fed to get things going this week. We had what markets seem to have interpreted as a dovish 25 basis point hike from the FOMC last week. I think that was largely because the committee removed from their statement the line that ongoing increases in the Fed funds rate will be appropriate. Although it must be said that the dot plot remains and was actually moved in a more hawkish direction than we saw in December. But as I said, the market interpreting that as dovish, a significant repricing taking place around about 60 or 70 basis points worth of cuts now priced in between May, when the market expects the terminal rate to be reached, and the end of this year. What I really want to get your views on, guys, is do we think that the market is correct on this? Do we think that cuts are likely as we move through the remainder of the year? Or has things gone too far, too fast, higher for longer still stands, and the market's got this one wrong? Ryan, let's start with you this week.
I'm so glad you came to me first. Thank you. That's the one that I'd least prepared for. Yeah.
Brilliant.
Oh no, that's fine. No, that's fine. That's fine. Right. So first off, what we got? So what would you say? A dovish 25. The way it was repriced afterwards, even though, like you said, the dot plot was slightly hawkish. The main plus point of the whole thing was we didn't have any dovish 50 hike headlines which would have just blown my mind. I think they rammed home, I say finally, us smart people in the room already knew this, but forward guidance is completely dead. And so it should be. I think I mentioned this on the last show. They didn't know what they were going to vote for until like 2 days before, the day before they were voting. So how anyone can stand by and believe any forward guidance, at least they're kind of admitting to it now. Next meeting, May 3rd, when we started recording this, which was about an hour ago, it feels like, FedWatch CME's FedWatch had market pricing unchanged at 58%, a hike 25 at 42%, and then no more hikes repriced, cutting in September, and then back to 3.25%, 3.5% target rate in September 24. I think what you need to remember is this is the question is the market gone too far? Yes, it has, but then the market always goes too far and a shift in sentiment. We know this. It's just market mechanics. It's not going to move to the exact place it needs to go to. It will follow through a little bit. So will it kind of ease back slightly? There's every chance. But I think the most important thing to remember as a retail trader or less experienced trader is these are just predictions, right? And it's very easy to forget that the market predictions. Not only that, but this kind of cut, which is what we're now pricing in on the Fed funds. That's basically saying we are pricing a perfect everything going our way for the next year and a half. When was the last time we went 3 months without like hiccups or anything unknown happening? These things just don't play out like the market intends. All you need. How often do you see people post on social media? these like what the curve used to look like and like all the time, and how does that compare to where rates actually went. It's never right. So forget where the market is priced right now. As I said, we are not going to get the perfect year and a half because other things will happen. Quite an interesting thing that was highlighted by the Fed is the fact that they're basically relying on credit tightening coming into play. And they actually state, what was the quote? Credit tightening would have the same effect as our policies do, i.e. a rate hike. So the market's then gone, okay, well, we're expecting credit tightening, therefore the Fed won't be hiking rates as much, or maybe they don't need to hike rates. What this does mean is if credit tightening doesn't play out, as many are suggesting, rate hikes will probably have to come back into play to balance that out, if that makes any sense.
Mm-hmm.
I think it makes sense. Also, just briefly, something that I know we're not talking about the ECB this week, but just something I kind of picked up on, which Goldman Sachs said to differentiate between the Fed and the ECB, is Fed, due to the relative US bank vulnerabilities, is penciling the credit contraction, whereas the ECB, even though we've had the Credit Suisse issues, there's not really been any credit contraction, if you know what I mean. And more importantly, they still have that, the issues themselves with the inflation. So there's a massive policy shift between, the Fed, the ECB, and the BOE, which I'm never going to get onto. I think in terms of a trade, I know everyone wants, what's your trade and all this stuff. I'm struggling to think of anything that the novice retail trader can do, apart from, if you do believe that we are priced correctly, the only thing you can really do is look to buy equities and look to buy tech, because low interest rates good for tech, right? Well, that's that's the new way of working. But what I will say is, time is the enemy. We've got 18 months of pricing now in the rates. The longer that time is, the longer that duration, the more time there is for things to go wrong. So that's where I am on that. Like I said, I think that I say TLDR. I think the market's gone too far, and I think it's too optimistic, and it's relying on everything to go right, and things just don't go right anymore.
Yeah, no, I would tend to agree with that. I mean, it would be nice if we had a period of time where everything went right for a while, but I don't think it's likely to happen. Ioan, I want to bring you in because while we were dealing with our technical gremlins earlier, I got a sneak peek at your notes, and I know you've got plenty to say on this. So what are your thoughts on the Fed and where we go next?
Yeah, I mean, talking like you said about the key drivers for policy outlook going forward. I mean, the summary of economic projections, nobody really delved too much into it because they were too concerned about what was obviously happening with the regional banks in the US. With that in mind, obviously, it looks like there will be some sort of slowdown. Personally, I look at the leading economic index. I mean, if you look at it, it's slowing down, so that will be key, a key driver for the policy outlook going forward. I think it was from the period from August 22 to February 23, it was down 3.6%. Now that compares with the 6 months prior to that, down 3%. So it is sort of decelerating at a faster pace. So that will impact forward earnings and going forward, some activity going in the real economy. So that's something that everybody will need to consider. The other thing I think that's not really on everybody's radar, but and it'll probably be one of those millennium bug things going forward, but it's the transition from LIBOR to the SOFR. But not really many people are talking about it at the moment. Maybe it's not a risk, maybe it is. But if something happens, there's no reason why they couldn't extend the deadline. But I think it's the end of June.
Am I right in thinking they've already extended the deadline on that?
Well, I think that it was extended to June the 30th. Yeah, so
it's been the worst transition ever, isn't it? It's been like
well, it has taken. And I think, to be honest with you, only 25% of the 1.4 trillion US junk loan market has transferred from LIBOR over to the SOFR. So that's something that it should be on everybody's radar. I'm not sure if it's a trading opportunity in any way, but it's definitely something to keep.
I'm pretty sure even Powell mentioned it at the last. I think he's mentioned it at a couple pressers. I think he's been asked about it, or he's commented on it.
But again, it might not be a catalyst in itself, but it's definitely something to think about. Because obviously there's an extra spread involved, and they're quite big markets as well, and there's always something around the corner. I mean, the US banking system's got about $1.5 trillion of commercial real estate loans that are due over the next 3 years. And these interest rates are like anywhere from 1 to 4 to 6 to 12%. So that's another thing that you need to keep on the radar. With all that in mind, one of the indices that I do look at is the St. Louis Fed Financial Stress Index. All these things, I mean, for those novice traders, it's just something to keep on your screen, just to give you an idea of, where we are and compare it to other events that we've traded through the years. I mean, it's now sitting at the highest level since the beginning of 2020. And, these levels are comparable to where we were heading into the GFC in September 2008. So, these
apples and oranges.
Sorry?
Apples and oranges. There's a lot changed since then.
Sorry?
I said there's a lot changed since then.
Well, I know that, but it's always worth keeping an eye on something. I'm not saying anything is set in concrete, but you've got to. You've got to have your own little triggers, your own little trade-in styles and things that you need to keep an eye on to give you those little triggers to enter and exit trades. I'm not saying it's the best thing in the world, and as things, the goalposts always move, but you've got to set yourself up in a way that's suitable to you, right?
No, I'd agree. Arno, I want to bring you in because unless you've taken a vow of silence, you've been quite quiet so far. So we've had a lowdown on what the Fed did, what to look at next. Where's the trade in the FX space to take advantage of this, if one indeed exists?
I don't think one exists right now, to be honest. It's too messy right now. We're talking about extremes. The market has basically flip-flopped from one extreme to the next one time and time again over the last 6 weeks, right? If you take a look at what's happened to the curve from the start of February to where we are now, it's just been a massive roller coaster ride for the market. So it's very, very difficult to get any type of medium-term bias pinned down. There's obviously a lot of smart people out there that claims that they've got that medium-term bias pressed down, but it's very tricky right now. I think there's reasons. Let's just take the dollar, for example. The dollar has reasons to go up and down right now. From a down perspective, we've got interest rate expectations that completely collapsed. That is something that should weigh on it. At the other end of the scale, though, is that when the brown stuff really hits the fan, there's only really one safe haven out there. That's the US dollar. So if things get really, really tough and credit conditions tighten massively like they expect, then I would expect that to create some support. But it's really a day-to-day trade right now. Now, in terms of, I think how we can look at this from a reaction function perspective, right, and how that could impact short-term flows in currencies, is that there was a big disconnect at the FOMC between the dots and what Powell actually told us. The dots showed us that they are super uncertain. They don't know what's going to happen. It might go lower, it might go higher. But he did stress and say, listen, he thinks markets should be focusing on the sum and the may, as opposed to focusing on ongoing. So I think that shows more willingness for them to be slightly more patient. And I think that's important from a data perspective, because they seem comfortable right now to kind of wait for the credit data to show them that contraction that they're looking for, like Ryan mentioned. And that might mean that they could be slightly less reactive to, dare I say it, inflation data, at least for the next 2 or 3 prints, because they'll be waiting for that, the weekly and the quarterly and the monthly, whether it's going to be the credit conditions or the lending growth or the deposits. I mean, the market is going to be all over that over the next few months. I think that's where the focus should be from a reaction perspective for us. If those things come in super, super negative, then we would expect that to be positive for your safe havens like bonds and the dollar. That could be a trade. and obviously negative for equities. But if credit conditions comes in and it looks okay, deposits stabilize, lending standards doesn't tighten, it doesn't, rocket to the moon like some expect it to, then that could create some nice risk on trades for us as well, which would mean dollar downside and equity upside. The other thing that I think is important right now, which didn't really get a lot of attention yesterday, is how this impacts the consumer. So we've got a couple of key indicators that we get every single week, and it's stuff that we don't really focus on, which is mortgage applications and jobless claims. If there's going to be any pain, that's probably going to be the first place we will start to see it. So something that I noticed yesterday with the consumer confidence report that we had, or consumer, consumer confidence one, is that there's obviously it looked better, but if you take a look under the hood, we actually saw a downward move for present situation index and an upward move for the future expectations index. Now, why that's significant is the spread. That is one of the most reliable indicators for recession warnings that there is the spread between present and future expectations. So what normally happens is going into a recession, consumers get...
Sorry, I hate to interrupt you there, but you've somehow ended up with about 50 points. I'm not entirely sure how I've done that. So
someone's fat fingered.
Let me bring you back down to earth. That's like that Deutsche CDS.
Well, we could leave it there, we could leave it there. Then we just So in terms of consumer confidence, what you tend to see is consumers get really stressed out about the future months before a recession. That starts to see present situations go down, or future expectations, go down, but present situation stays fairly high. And then when things get really, really tough and the shit hits the fan, the brown stuff hits the fan, what you tend then to see is that suddenly you see present situation expectations plummet. And that is when you normally see a recession. So I think those are the types of things that the Fed will be looking at, is that whether we want to, there's many things we can look at, but they have really two questions. What implication does all of this nonsense have on credit availability for businesses and consumers? So if those things slow and it impacts it, we'll know where the safe havens are. We'll know where the risk on trades are. And I think that's really, it's a data point to data point, function right now.
Forward guidance is dead, right?
Say again, mate.
Forward guidance is completely dead at the moment. I know Michael was itching to go to the next subject, but just briefly. So we know in the past, Powell, and it's been mentioned, we know he hates it when stocks rally when he's talking, right? We know he thinks stocks are priced wrong. He always has insinuated that the market is wrong pricing stocks this high. Do we still think that he believes that, or does he think now we seem to be coming off the gas for rate hikes? Do we think he's a little bit more flexible with the current pricing? Because this not beat around the bush. We do know that Powell hated the fact that markets were rallying every time we had a Fed announcement.
I think that's a really, really good question, mate. I think.
Oh, stop it!
I think when it comes to what the equity markets do, and even at least for the next 2 or 3 months, what inflation does will be less important. I think he'll be looking at the impact that this has on credit, because they're willing to just step back right now and say, okay, let's just see what happens. Let's see what happens to credit growth. Let's see what happens to the availability to consumers and businesses.
That's exactly my view. I think focus on that. He's not. I don't think they're too concerned anymore what the price of equities is doing, which 4 months ago, 6 months ago, they definitely were concerned about that. So anyway, that's the only point I wanted to make. We can move on now.
I would agree with that, and I'm now going to wrestle back hosting duties from Ryan, who's trying to take over, and we will move on to the Bank of England. Right, the old lady Ryan's giving us a little tune while we talk, which is lovely to have a little bit of a musical accompaniment as I almost knock my water over. The BOE last week, I guess you could probably argue that it was, if you're going to say the Fed was a dovish surprise, you could probably argue that the BOE was more of a hawkish surprise. We got a 25 basis point hike, but we also had a 7-2 vote, which was identical to the vote split that we saw at the February MPC. We were expecting 1 or maybe 2 policymakers to join the dovish camp, preferring to keep rates unchanged. And we also had a repeat from the BOE of their previous tightening bias, saying that if signs of persistent inflation emerge, they will raise rates further. And Andrew Bailey, when he spoke earlier this week, repeating that, although to which I would counter CPI has been above 10% for 6 months in a row. I'm not entirely sure how persistent things need to be for the BOE to go further, but there we are. Ioan, I'm going to start with you. Sterling has rallied a little bit, although I'd argue that's more a function of dollar weakness than anything else. Cable trades north of 123. How do we interpret what the BOE have said? What do we think they're going to do next? And can Sterling's relative strength continue for some time?
Will the BOE even know what they're doing?
No.
I mean, we touched on this on the previous episode, didn't we? About how long it sort of takes for rate hikes to filter through the system. We've had 11 straight now to get where base rates are. And we've sort of suggested that it takes, between 9 to 12 months for interest rates to start to have any sort of influence on inflation itself. Now, obviously, there's extraneous events like Ukraine, Russia, oil price spikes, whatever. But I mean, all the Bank of England has done is batter the demand side of of the economy by raising rates, just as higher taxes and any energy bills start to bite. So in effect, I mean, all they're doing is restricting disposable income. So basically, the higher taxes and energy bills should have been doing the job for the Bank of England anyway, because they sort of impact spending on that front. But I don't think it'll be until the summer or maybe early autumn that we'll see just how damaging these interest rate hikes have been. At the same time, if the Fed pause or start to cut rates, do the Bank of England follow? I mean, usually we tend to see that when the Fed starts to move, then there's some sort of cessation or pause from the Bank of England itself. We've seen a slight drop in energy costs. Petrol at the pumps are coming down a little bit. But obviously we've still got these wage pressures coming through. So they, from the recent base rate hikes, but they haven't really bitten yet, I don't think. So it's still going to be a test in time, for businesses and consumers going forward.
Yeah, no, I agree. Ryan, you're the biggest sterling bull in the world most of the time.
I am.
Are you still bullish, Cable, at the moment?
I am, very much so. A couple of things that just want to raise. One, I don't think it's fair that Ioan gets a point purely for saying the words, do the BOE know what they're doing? I noticed he got a point for that, and I'm not happy about it. I'm just going to make that very clear that I'm going to be speaking to the stewards afterwards. But anyway, I digress.
The stewards are me, so...
all right, Ioan, all right.
there he is.
So one thing I think we should think about is, Ioan's completely right, as much as I hate to say it. BOE, did they need to be raising rates so much when the cost of living was soaring? Not really, possibly, but then we can also say the same for the whole of Europe. Where everyone was in it together. This is not single out just the BOE. I think a headline that came out yesterday, which is very concerning for the BOE in particular, was Kantar, which are a huge market research company, for those that don't know. When I say market, I mean kind of consumer market. Yesterday, they came out with their UK grocery price inflation, which hit a record of 17.5% over the 4 weeks to March 19th. Now, 17.5% in 4 weeks, it's not great. I think that's something, okay, energy prices are coming down. Well, energy prices have come down because nat gas has gone through the floor, oil's gone through the floor, petrol's coming down. However, inflation's still here. And I think the massive concern, if energy prices do take a bid, that's the deflationary pull on current inflation figures gone, which means we're going to just go shoot straight back up. And I think that's something that people aren't kind of quantifying so much. And I think they need to. Goldman Sachs lowered their BOE forecast terminal rate end of last week by a quarter. I think they've removed the hiking in May, where they see additional growth dragging and types of bank lending. What Ioan moved to that. Again, I know I've said it before when we're talking about the Fed, and I say it every week. forward guidance is completely dead. So it's just stop talking about forward guidance. Even though the Bank of England did dodge the recent banking woes, in theory, you would say that means the pressure isn't on them to cut rates so much. Obviously, what everyone's saying about the Fed, you need to cut rates because of the banking thing. But will they have to, as you said, will they pause purely because the Fed are looking to now pause and start cutting? The most important thing about all of this, and I know I keep saying it again, I am a broken record on this.
Well, not just this, but
true. We need to remember that ultra low rates are not normal, and they should not be normalized. They cause more problems than they solve in the longer term. We've seen that. That's indisputable that low rates, zero rates, cause more problems in the longer term. 4% rates should not be feared by anyone. The only people I know social media will tell you that 4% rates is like one of the signs of the apocalypse. It's not. Anyone that says that is fucking out of their mind, right? Sorry to swear. 4% rates is healthy. We know this. The only people that are
sorry, you're right. You're right there. You're absolutely right. The only issue is it's the velocity, right?
Yes, exactly. Well, put it this way, the only people that fear rates trickling up or rates above 3% or 4% or whatever are those that are already over leveraged and maybe unhedged, right? And let's be honest, again, as has been proven many, many times before, the over leveraged and the underhedged need to be flushed out the market occasionally, because when they're not flushed out the market, these things build, and when eventually something goes wrong, we're all screwed. Okay, because it's just it's liquidation everywhere. So I'm a big fan in keeping rates where they are, or if we get an opportunity to hike further. Because one, it's not a killer for equities. Let's be honest, equities will trend up eventually anyway, or not even eventually. They might take a small roadblock. They're not going to get smashed because rates are 4% rather than 3%. If you believe that, get out of the room. All right. So on top of this, because I don't feel that the BOE need to be cutting or should be cutting, but I do believe the Fed will because of the pressures that they're under. Of course, I'm bullish cable. What else wouldn't I be? Well, of course,
that's just to wind David Bell up, though, isn't it?
That is about 50% of the reason. I'm not going to lie. But there you go. I know I'm a broken record on most of this, but I just think it's very.
Arno, what are your thoughts? Are you as bullish cable as Ryan and also other parts of the FX market? The what's the word? Narrative. You can tell I haven't had enough coffee this morning. Seems to be shifting towards pauses and cuts. Are there other opportunities we can take advantage of in light of that, particularly when you've got someone like the ECB saying we're going to hike into the summer? Chief Economist Lane was out this morning saying, the baseline scenario, there are going to be more hikes. What should the trade be based on that?
Patience, mate. I think, right now, I don't see a lot of value in playing differential trades because there's so much uncertainty right now. I think a lot of the I'm going to hike bigger than you type of trades, I think a lot of that played, in the first quarter of the year already, or the first 2 months of the year already. A lot of that, I think, is understood by the markets now, and it's been digested by the markets now. So I'm not too excited to be trading a differential play right now, just because I think it can change. It can change next week. There we can suddenly something happens in Europe, and then actually we're not going to be hiking rates as aggressive anymore. So I don't see a lot of value in taking differential trades at this stage. When it comes back to something like sterling, I'm less concerned about what the Bank of England will do because I don't think they know what they're going to do, right? We had them coming out, like you said, slightly more hawkish at face value, but they sounded very, very, very confident that CPI will slow considerably in the months ahead, even after the upside surprise that we had in CPI. So I'm not sure what level CPI needs to get to convince them otherwise, to be honest. But again, we know that this is a bank that doesn't really care what the markets think or what the data says. They'll just be doing whatever they think they should do.
I think they care about data and stuff, but I like the fact that they don't care about the market, because
unlike the Fed, right? Unlike the Fed, if the Fed can be forced into hiking or not hiking, the BOE, they don't care. It's like the RBA; they will just do whatever they think is right.
Yeah.
So I think it's impossible to know where the BOE goes from here. But I'm less focused on that right now, to be honest. I'm more focused, and I know we're all broken records at this stage, but I'm more focused on the growth data. That's been the biggest driver for sterling over the last 3 months. It hasn't really been Bank of England expectations. That's seen some short-term fluctuations, but if you track the big moves, it's all been down to the growth data. So I still like euro sterling lower, even though it's not an active short. It's not something that I'm perpetually short, but we've traded in and out of that over the last 3 weeks or 3 months rather. And it's been that's the way that I'm going to trade it. If we get really big upside surprises, growth surprises in the UK, I like to play that against the Eurozone or against the Euro. And that's really the play for me right now. Apart from that, I'm not in the differential camp. I think there's less value to trade that right now because it can change.
For the record, I'm taking that as Arno's bullish cable, just bullish sterling.
Bullish sterling, but not quite as bullish as you. Cool. Well, we're halfway through the show, so let's go on to the next round. Right, banks, markets appear to be breathing a bit of a sigh of relief. I think it's more a case of kind of no news is good news than anything else. Credit Suisse, I don't want to tempt fate, but it appears that the issues there have been largely solved by the acquisition by UBS. Doesn't seem to have been too much contagion into the rest of the European banking sector. If you look at US regional banks, the problems there don't appear to be getting any worse. I think the market is taking some solace in the fact that no one else has gone to the wall over the last kind of week or 10 days. Arno, I want to start with you. Do you think we're completely out of the woods, or is this just kind of the calm before the storm resumes, I suppose?
Before we started today's session, I was in the camp that from a short-term perspective, we're out of the woods. But let me just be the first to acknowledge that nothing that we say about equities will really matter today, because we had Jim Cramer coming out on CNBC saying that he thinks we're going to have the biggest rally that we've seen in decades. So,
right.
That puts us all at risk because we think short-term equities might be going higher.
Has Macro Ralph tweeted that as well?
Probably.
Sorry, can we just pause the show while I go and move my pension into cash and then come back in a couple of minutes? Is that all right?
So we all know what that means for equities, but I think what right now it's a lack of bad news. If we draw up a chart of the S&P, we've had some serious stresses coming into the system, and equities. I mean, we were down a little bit, but this isn't a market that has been, freaked out and concerned. I think what we're seeing right now, the reason why we've bounced is it's a lack of bad news. Everybody got, went all Lehman, on equities. It's
the path of least resistance, right? I'm a massive fan of the path of least resistance, and the path of least resistance is on a natural kind of neutral element. It's higher. And that's exactly what we've got now.
Because if you consider what's happened, we've had interest rate expectations collapse. That should be good for equities. We've had short-term liquidity increasing. Now, I'm not going to go into that because it's short-term liquidity that increased, not QE, etc. But that should be positive for equity. So as long as we don't get more bad news, I'm not sure what's going to push equities lower. Obviously, if we see credit conditions really get stressed out, if we see confidence from a business and a consumer perspective fall off a cliff, that's going to be stresses that the system will need to worry about. But I'm not sure what the market needs to see for equities to go down. And if that's the case, then like Ryan said, the path of least resistance seems more likely higher in the short term until we get bad news. So until we get bad news,
I hate the whole no matter what we go up or every situation we go up. But at the moment, least resistance is higher. Yeah. If we do get some bad news, interest rate expectations are going to drop, which is also bullish tech.
Yeah.
I hate to be in the, no matter what happens. Basically, what I'm saying, I'm not saying no matter what happens, we go higher. But what I am saying that if things kind of do calm down or we get good news, we go higher. The only real way I can see sustained downward trajectory for stocks is if something really bad happens. tempting fate, but you can't trade for a living constantly expecting bad things to happen.
No, and I mean, there's a lot of, if credit does dry up massively, we're probably going to get a hard landing. But that's not going to happen tomorrow, right? We would need something, we would need the economy really falling off a cliff. And that's still possible, by the way. But we would need that to happen to see another leg lower. Right now, the market seems very well behaved for everything that's happened. And for me, that this doesn't scream sell equities right now. Look, I'm not a medium-term buyer here of equities. I'm definitely more of a short-term, playing this from a short-term sentiment perspective. But it needs to be really bad news, I think, to get us lower. And also consider how many people went short over the last 2 weeks. Everybody diving into short positions. If we break these critical levels of resistance that we're testing, that's going to trigger a ton of stops. That in itself could see a big rally just because of liquidations happening on that front. So we need to consider how bearish the market got, how quick they got there, and what the likely response will be if markets just keep on pushing higher.
Absolutely. Ioan, what are your thoughts on all of this? Are we out of the woods? Can we put our feet up and forget the whole banking crisis, or is there more still to come?
I mean, I don't think you can forget about it completely, but I mean, there is a sort of relative period of calm at the moment. I mean, obviously, we've touched on, where the VIX is or where the MOVE index is. I mean, the VIX isn't really doing anything when you consider what's happened of late. Didn't really get too elevated. I don't really look at the VIX in isolation, and I compare it to things like the SKU index. Again, that isn't really doing anything or screaming anything untoward to me. So it looks like there's a relative period of calm where you can take some decent positions and just trade those outside moves. I can't really see what volumes are like today, but the volumes are going to give you a decent clue on where we are. And then, if you're just touching on Arno's point there, about, the consumer and credit, I track the, velocity of M2 in the US. I mean, that hasn't, it started to climb off lows, but it hasn't really done anything. So it's not suggesting that, the economy is being driven by, stored up savings or anything like that. And likewise, for the Eurozone, I mean, if you look at the ECB's rate chart, I mean, they always seem to tighten into recessions. I mean, we touched on it last week where, Trichet hiked into that oil price spike, back in 2008, right? And then they did it again. They raised rice twice in 2011 into the Eurozone crisis, which obviously led to, the Italian phase of that crisis. And then, even last week, I mean, not last week, Lagarde, she's hiked now with GSIP, bank going bust. And, there's... I agree there is a relative calm at the moment, but there are things lurking underneath that you need to be aware of. But I'm not saying it should restrict you from taking any long positions. But like Ryan said, if there's a cessation in rate hikes and we get some sort of pause, some relative calm on the rate hike front, and then the market starts pricing in cuts, then that too is positive for the equity market. I mean, going back to the ECB, the M3 money supply data, it's well below their 4.5% target. I think the last time we got an update, it'll be around 3.7%, I think was the last one. And then, selling price expectations in Germany is starting to point towards, falling inflation as well. So they're looking at around 3% by the summer. So, that's when the bloc could be in a recession. So, and then that forces the ECB to start cutting aggressively again. And like we've said, I mean, if the central banks, start providing a little bit more liquidity again, then that's when, people start to buy the market.
Can I just
Ryan, if you can keep your thoughts brief, please do.
So very, very briefly, Obviously, so the topic of this round is risk. Well, I had risk, but you've got banks on there, but so I'm not sure what happened there. But yeah, when we talk about risk on, risk off, the traditional kind of way of thinking about stuff. I know it sounds a bit kind of old hat and whatever, but we're just coming into a new quarter, right? There's been plenty of money on the sidelines due to what's happened in Q1. You cannot forget, you cannot kind of negate the fact that there's been a load of money coming in. Well, there's been a load of money sitting on the sideline. There's been a lot of money going out of risk markets. At the moment, based on everything that we've all three of us have said, or four of us have said together today, if you've got a lot of money that you need to put to work, start of Q2, start of a new month, everything is looking calm. You will be forced to put that money to work because you cannot afford to miss the next rally. Right? That's what, for money managers, that's what they're worried about. So I think, and again, it comes down to that path of least resistance. What you've got helping like the push of that least resistance is the fact that there is a shitload of money sitting there that will be put to use in the very near future. And personally, why wouldn't you be putting it into the risk markets, i.e. buying stocks?
Yeah, absolutely that. Cool. All right. Well, I think that's a brilliant way to end that round. So let's get on to the last round of the show. So for once, I've actually had to do a bit of homework before this show because Asian markets are not something I look at particularly often because they trade while we are all asleep. And even though none of us get much sleep, I don't think we're up at 3 a.m. looking at what's going on in Tokyo much of the time. But I do think the region is probably worth a look because if you read what the sell side are saying, and of course take that with the usual caveats, most seem to expect growth to outperform East compared to what we're likely to see in Europe and the US this year. If you also look at the banking sector in particular, the problems and issues that we've had in Europe and in the US don't appear to have they don't appear to have had anything like those sort of issues over in Asia just yet. So, gents, should we pay closer attention to this than we are? Are there any specific risks or even benefits that we could consider from that region that traders should be paying close attention to? Arno, you're nodding away, so I'm going to come to you first.
Look, no ETFs or indices that I'm looking at right now, but I'm keenly focused on FX right now for Asia and specifically the Aussie dollar. I'm keeping a close eye on general risk appetite here for the Aussie because I know in this environment it's been it's been pressured, but I think it is underloved, if I can use that term. Firstly, we've had commodities rally massively. Copper has put in a decent recovery rally alongside oil. General commodity markets are doing well. We know that is normally positive. If you just use that as a proxy on a chart for any Aussie pair, it means that it shows that the Aussie might be a little bit underloved. Also, the markets, got all frantic about the RBA that they're not going to raise rates anymore, and that means only bad things for the Aussie dollar. But we have the exact same expectations for other banks as well. We've got the exact same expectations for the Fed to cut rates even more so. Everybody is expected to slow down because we are getting close to terminal rates anyway. So I think as long as we don't get any short-term big negative news on the bank side and equities can put in a bit of a relief rally, which I think right now, like we said, that's the base case or the path of least resistance, that should be supportive for the Aussie dollar. Now, when it comes to China's reopening, that's been kind of long forgotten now by the markets, right? That means that incoming data from China, especially the NBS PMI data that we've got coming up on Friday, if that continues to show us a really good rebound in the growth, that's going to trigger some remembrance that, hey, you know what, there's actually another place in the world that might be growing this year. And I think that should be on balance positive for the Aussie. The obvious risk here for the Aussie is that it is a high beta. So it's just that if we get any massive bear case moves in equities, that's going to pressure the Aussie dollar. That's something we need to look at. But I like some exposure against the yen if yields and equities recover a bit. Some exposure against the Kiwi, if Chinese PMI data can come in stronger, against the euro, because I just hate the euro right now. I can't get myself to like that.
That's what you really think, mate.
I can't get myself to like it right now. The one thing that I absolutely hate hate about the Aussie dollar right now, and I mean absolutely hate about it right now, is that the retail crowd agrees with me, which is never a good thing.
There's nothing wrong with retail. There's nothing wrong with retail.
No, nothing wrong. But 85 or 69% of retail is currently very long the Aussie dollar and thinks it's going to rally. So that is it's a little bit of a concern that I have. I don't like being in that type of stretch position. That's the only thing that I have against it. But that's really what I'm watching on the Asian front. I mean, in terms of indices and ETFs, I don't really have an edge on that right now when it comes to Asia. But I'm keeping a close eye on the Aussie dollar because I do think it's a little bit underloved if we get that recovery in risk that we're expecting.
Yeah. Some say he doesn't have an edge on FX either, but we can let him have that one. So Australia, China, are you watching those two as well, or something else on your radar?
Well, like you, I mean, you just, you have it there. You have to take notice of it, right? I did note recently the EPFR data was, quite strong in terms of how much inflow that Chinese money funds had received, and it was quite close to record, if not the record. But so far this year, I mean, I did notice that there's foreign investors have bought nearly 6 billion of China stocks via the China Hong Kong Connect scheme. That compares with 12 billion last year. So the run rate's obviously got much higher than it was throughout the whole of last year. So, I mean, that ties in with the first, pro-growth alignment of, COVID management and economic policy to tie in with that regulatory aspect as well. So, they're all aligned for probably the first time in probably 4 years. I mean, when was COVID now?
3 years ago, wasn't it?
Yeah. The CSI 300 benchmark is still, 30% off its peak that from February 21. So, the way that you play that, I mean, some people or traders, they normally jump in front of, any Chinese rally by using Vietnam. So you obviously can trade Vietnamese ETFs. I always tracked the A50 futures, which trade in Singapore. I think Pepperstone have an ETF tracker.
I think they might have one.
Actually, I think the ticker's CN50. Might be worth looking up.
Well played.
I mean, that index was obviously projected to dominate, Asian exchange traded derivative markets. So that's where you'd go. It doesn't give you that, obviously, the whole CSI 300 exposure. But I think if you're playing the Chinese growth, then you want to be in the large caps, and I think the 50 gives you that.
No, I think you're exactly right. Ryan, I'm going to wrap up the show with you. I'm sure you've got some weird and wacky ETFs that you've found as well.
Firstly, I realised I've shot myself in the foot by telling Ioan before he came on for his first show that the easy way for a few points is to quote a few Pepperstone tickers. I'm really regretting that right now. Anyway, also, I have made notes of other people talking rather than interrupting. I'm trying to get better on that front. I don't know if everyone's noticed. But my good friend Arno mentioned about commodity prices. I think it's very important to remember that obviously, as commodity prices are doing well for certain countries like China, obviously does well. Copper's obviously goes up as they're improving. But we need to remember what a massive importer of energy products that China are as well, which is why it's kind of a good thing that oil prices haven't really rallied. I think that also is great for them. And I think we've seen in the past couple of days, over the last 72 hours, there's been the huge Saudi Chinese petrochemical landscape has really shifted. So it appears that Saudi Arabia, Aramco, so we'll call it Saudi Arabia, are really pushing into China to actually open up a few more refineries over there. Basically, they're looking at that is their big market. When you look, I know it's not really on topic, but it sort of is. But when you see how much the US are now exporting, I believe they're now an exporter of crude. So I know they are. you can see the whole kind of that kind of energy landscape is now shifting in China's favor, which is something that will be a little bit of a benefit. But anyway, so that was on that. Going back to just Asia as a whole, I think geopolitically, which is kind of always my kind of favorite area to be in, China, Taiwan isn't going anywhere. In fact, it's kind of it's one of these perennial kind of it's never an issue until it is kind of thing. But at the moment, as in, I believe he's actually traveling as we speak. The Taiwanese president is going to Guatemala and Belize, all right, for some. And in classic shit-stirring fashion, to rile the Chinese, he's transiting New York and LA. And so the idea of a transit is basically you don't even get off the plane. We know that's not going to be what happens. Apparently, he's meeting the House Leader, I think it's House Leader McCarthy in California. China have already said this is really this is a red line for them. I believe the actual quote from one of the Chinese spokespersons was, if she has contact with US Speaker McCarthy, it will be another provocation that seriously violates the One China principle, harms China's sovereignty and territorial integrity, destroys peace and stability in the Taiwanese Strait. Now, we're used to them using punchy language. I think this is more punchy than normal. And obviously there's a few, war kind of bullish war hawks and like World War III lovers that are suggesting that as soon as she's out of Taiwan, that's when China's going to invade. That's not going to happen. We know that's not going to happen. However, we may see some people playing silly buggers, which I think is worth keeping an eye on. On that note as well, on kind of Chinese relations, I don't know if anyone else has picked up, but Germany has really shifted against China in the past week or so. Obviously, Merkel would kind of put up with a lot of crap to keep the trade going. There was an article in Politico yesterday, I believe it was. Basically, the current, those in power in Germany, policymakers turn their back on that. They're saying, look, do you know what? We're not going to be putting up with a load of crap in return for trade. They've also suggested they're going to put some export controls on various things, which, when you look at it, try and look at it from a neutral standpoint, it will hurt Germany more than it hurts China. But it just shows you that, this kind of, we'll just put up with China with whatever they do, that whole kind of way of thinking is definitely out the window. Just pushing on with kind of what Ioan said as well, about it's market-wise, it feels like it's a safer place to be, especially for cash. Seeing the money going into stocks by the Connect route. The last week, we've seen China definitely make some positive moves regarding a free markets, obviously not completely free. I think yesterday the big news was Alibaba is splitting up into six companies. That for me is a very capitalistic move. I'm not sure if that capitalistic is a word, but it is now. Mainly because basically saying that we will IPO all of those side markets, right? So basically they are trying to create more ways for market participants to get involved. Obviously, you can also say they're doing it because they want to break up a big company, but the way they're doing it and the way they said straight away that these companies will be IPOing, for me, is saying that we're looking to get more markets involved. So I think that's quite interesting to keep an eye on.
Ryan, just in the interest of time, I'm going to give you 30 seconds.
Sorry. One last thing as well, which I think is really important, is financial institutions are being allowed to knock on the door to move into China. We know they don't knock on the door unless they're already given a nudge to say that they're going to be welcomed. I think in the last week or so, we've seen some huge US Western financial institutions greenlit to move in, which again I think is really good for the outlook for China. I know people hate China, but to be honest, I think I'm quite bullish for Chinese.
Good stuff. On that note, let's have a look at the final scores. Well, this is very annoying because it means I may now have to buy Ryan a pint tomorrow. Ryan, well done for winning.
Mate, you don't have to say it like that. Jeez.
Well, I can't expense
there
it.
I am.
There he is. There we go. Cool, good stuff. Well, thank you as always, chaps. Ryan Paisey from PiQSuite, Arno Venter from Financial Source, and Ioan Smith, who also looks remarkably like a younger Ryan, the 20-year financial market veteran. Thank you also to our producer, Kyriakos, for pulling this all together. We will be back very shortly indeed, and look forward to seeing you then. Thanks for watching, and goodbye for now.